Hi guys, welcome to 365 days, 365 concepts. The concept that we're going to understand today is enterprise based or enterprise value based valuation. Sir, what do you mean by this? We are talking about EV to EBITDA ratio. That means enterprise value to EBITDA ratio. Sir, what do you mean by enterprise value? Sir, enterprise value is the value of the entire company. Okay, sir, we get this. Sir, how do you calculate it, sir? Whenever I have to acquire the entire company, I will have to acquire its equity shares, its preference shares, its debt. So, sir, what is value of the company, sir? Sir, value of the firm as an enterprise value, sir, it will be market value of equity plus market value of debt plus market value of preference shares. Sir, that means to acquire the entire firm, I'll have to buy out these three sources of capital. Sir, but okay, you pay a certain cost to buy the company. We get that. That means enterprise value is market value of debt, market value of equity, market value of preference shares. But as soon as you acquire the company, you get access to the liquid assets, assets that are liquid. Sir, what do you mean by this? Sir, cash, short-term investments. Sir, you get access to those assets. That means ultimately the person who has acquired the entire company basically, has paid the enterprise value of the company. Their cost would be reduced by these liquid assets. That means whatever they have paid for the company, their cost will be reduced by the cash that the company holds and the short-term investment that the company holds, which are liquid. So, sir, what is enterprise value? It's the value of the whole company, whatever you would pay to acquire the firm, and we have understood the formula. Sir, why do we use this particular enterprise value as a metric? Sir, because capital structure across firms can be different. Sir, what do you mean by this? Let's say there is company number one and company number two. Company number one has a lot of debt in their capital structure. Sir, because they have a lot of debt in their capital structure, their interest cost is very high and ultimately their earnings are very low. Sir, because the interest costs are high. Sir, if earnings are low, that means EPS will also be low because EPS is earnings divided by number of shares. Sir, but when I talk about second company where the debt is not that much, the debt is low. Sir, the interest cost is not very high, it is in fact low. That means, sir, here the earnings are going to be high because the interest cost is low and ultimately EPS will be high. Okay, sir, but what is the implication of this? Sir, I hope you guys understand the capital structure of both the companies is different. Sir, first company has a lot of debt in their capital structure and the second one does not have a lot of debt in their capital structure. Okay, sir, but what are you trying to reach at, sir? Let's say, for example, I talk about P to E ratio. Here in company number one, sir, EPS is low. That means the P to E ratio will be high because denominator is EPS. Sir, here the EPS is high. That means P to E ratio will be low because the EPS, which is denominator, is a high number. Okay, sir, we get this as well. So that's why we cannot use EPS and because the capital structures are different. Okay, we get this. But sir, what are you trying to imply at when you say all of this? Sir, enterprise value is a much better metric because you can use it across companies irrespective of their capital structure. Because in this metric, which is EV to EBITDA, you use EBITDA and EBITDA is before subtracting any cost of capital. It is before interest, it is before preference dividend, it is before dividend. And that's why you use it. And sir, generally EBITDA is positive even when the earnings of the company are negative. So even if the company is suffering from losses, generally you will see that the EBITDA is positive. That means if EPS is negative or earnings after tax are negative, sir, ultimately, sir, your EBITDA is usually seen to be positive. So sir, if EPS is negative, can I use this ratio, sir? No, sir, because denominator is negative, then how can you even find an answer? Okay, sir. And sir, what if the market value of debt is not available easily? Then what do I do, sir? Then I use the book value of debt. Sir, what is the interpretation of this ratio, sir? Let's say, for example, EV to EBITDA ratio is 10 times. What does that mean, sir? For every 1 rupee of EBITDA, the company has an enterprise value of 10 times. And that is what the interpretation of the ratio is. I hope you guys understood everything. Please feel to reach out in the comment section if there are any doubts. Please like, share, subscribe, and comment. Thank you so much. And I'll see you guys with another concept. Bye bye.